There are some rumors coming out right now that we absolutely need to address. There are some crazy things going on in the market right now. The market is up pretty significantly again today. We're going to do a technical breakdown going over every single piece of news that was extremely relevant to what happened today and where I see things going in the future. So guys, before we get into all of that information, if you do enjoy the information and analysis that I provide for you guys in these videos, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. If you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So let's get right into it here and pull up the chart of the SP 500 ETF, the SPY. We're looking at this on the daily time frame here. And if you guys have been paying attention to a couple of my previous videos, we have been talking about the potential for a relief bounce. Now, we don't have volume necessarily pulled up on this chart right here, but you can see that the volume on these moves up are decreasing. So that's a sign of a couple of things. One, it could mean that this move that we're seeing to the upside is going to be short-lived and we come right back to the downside. The second possibility is that this is a result of overall market-wide shorts covering their positions at or around the more recent lows that we have seen. That's pushing us back up to 376 and providing us with a lot of that buying pressure. Now, if you look at the SPY right here, you have the RSI crossing above its moving average on the daily time frame and pitching back to 50 here. You have the MACD about to flip. You see the histogram is also losing that momentum as well. But looking at this on the 4-hour time frame, you are going to see something a little bit more aggressive. You see this MACD building that bullish momentum here. The ADX is showing you that it's losing that downtrend. The RSI is getting almost into that overbought territory here when we are seeing these very, very significant gains back to the upside of the overall market. Now, again, I do want to shout out some of the people in our group that are absolutely crushing it. Kenny, absolutely murdering the market. Congrats on the AMC call position there. Again, guys, if you guys want to come to the best place to learn how to trade, the algorithms that we have, there is nothing else like them out on the market right now. Our Trader Joe algorithm's up about 35%. Pythagoras, the predictive algorithm, is absolutely crushing it. If you guys do want access to these tools, make sure you guys check out that link down below. But coming over here and taking a look at what happened with the dollar today, again, when you look at some of the news, China is selling a lot of US dollars, putting that additional pressure to the downside on the dollar here. Typically, when we do see the dollar decrease like this, again, down about 1.34% today on DXY, the dollar index here, well, we are going to see equities start to move to the upside. You can view that as a little bit of inflationary pressure on overall equities. Now, we have to get into this large rumor that is circulating around in the market right now because it is incredibly important in the implications of what could potentially happen because of market participants thinking in this way is going to lead to a lot of volatility. So what we first need to look at over here is some of the key pieces of data that came out today. Shocking. Jolt, biggest crash in job openings on record outside of global pandemic lockdown. So as job openings tumbled to just above 10 million from a downward revised July print of 11.1 million, a collapse of 1.1 million in job openings, the biggest 1 month crash outside of the pandemic global lockdown crash in April, which was clearly an outlier. Now, again, still, while the first derivative of job openings was a disaster, the absolute number of openings remained high at 10.05 million. There was still a generous 4.039 million more job openings than unemployed workers, which nonetheless was the lowest number since October 2021. Now, coming down a little bit further here, it wasn't just job openings which plunged, hiring did too. And in August, the BLS, the Bureau of Labor Statistics, reported that total hires dipped to 6.277 million, which had been the lowest print since May 2021. Now, you might be thinking about this here, and what does this exactly mean? It means that people are now going to start pricing in that Powell in the United States Fed can start to pivot some of their policy actions. When we come over to this article right here that came out today, global bonds and stocks are rallying on the hopes that the latest signs of weakness in the U.S. economy will push the Federal Reserve to rethink the aggressive monetary policy tightening that some fear will trigger a recession. The so-called Fed pivot has long been hoped for, and it received another boost on Tuesday with data showing the number of U.S. job openings fell 1.1 million in August. So they're looking at these numbers here and saying, well, with these job openings decreasing, you could see that start to affect unemployment, and then Powell can come in and start being more dovish. But here's the problem. When you come over and take a look at some of Powell's more recent statements, specifically at Jackson Hole, which is a very, very pivotal moment, we are moving our policy stance purposely to a level that will be sufficiently restrictive to return inflation to 2%. At our most recent meeting in July, the FOMC raised the target range for the federal funds rate to 2.25 to 2.5%. It's gone up even more with the more recent rate hike, which is in the summary of economic projections, ranges of estimates where the federal funds rate is projected to settle in the long run. In current circumstances, with inflation running far above 2% and the labor market extremely tight, estimates of longer run neutral are not a place to stop or pause. Now, coming down a little bit further, we have to take a look at Powell's comparison to the 1970s, and that's right here. Now, this is something that we really have to be worried about. If the public expects that inflation will remain low and stable over time, which obviously they do not right now, absent major shocks, it likely will. Unfortunately, the same is true of expectations of high and volatile inflation. During the 1970s, as inflation climbed, the anticipation of high inflation became entrenched in the economic decision-making of households and businesses. The more inflation rose, the more people came to expect it to remain high, and they built that belief into wage and pricing decisions. As former Chairman Paul Volcker put it, at the height of the Great Inflation in 1979, inflation feeds in part on itself. So part of the job of returning to a more stable and more productive economy must be to break the grip of inflationary expectations. If the Fed were to pivot its policy stance, it is going to lose control of all of these inflationary pressures in the market. If they are not raising rates and trying to get to this more restrictive policy, well, then you are going to see inflation continue to go up. Again, remember, we've talked about this a lot. It's not so much the risk. The risk isn't as much that they raise rates too much. It's that they back off too soon. And you see a situation like this start to really, really form its ugly head. Now, the problem is that since this employment data was released today, a lot of people are now pricing in that, well, Powell could actually pivot. But let me actually come over here for a second and pull this up very quickly so that you guys can see this over here. If you look at the actual projections for what the federal funds rate hike or the federal funds rate and the rate hike is going to be at the November meeting, well, if you guys follow me on Twitter, we saw that this probability for a 75 basis point rate hike was around 54% this morning, and it has since jumped to 68%. So when you look at this data right here, all of these talking heads on the news are going to be spreading the narrative of, oh, the Fed could actually pivot. And there's a rumor that the Fed could actually come out and start to back off and become more dovish. This data right here is not telling us that. And the statements previously made by Jerome Powell are also not telling us that either. So I'd be very, very careful in hoping for the Fed to really come in and basically broadcast all these dovish statements. In my opinion, I don't think the Fed is going to pivot necessarily this soon. There is still some more room for them to go up, especially with what we've seen in the labor market. And we haven't even really touched on the oil situation yet. As we come over here, oil prices could soon return to $100 as OPEC Plus considers a historic cut in output. And this is going to be coming out tomorrow. So make sure that you guys are aware of this as well. Remember, energy is a very, very key component of CPI, the Consumer Price Index, which is going to track the inflationary pressures on the market. If you start to see gasoline start to go up again, oil is going to be coming back up. Remember, there's going to be more demand because the cost of heating people's homes in the wintertime, well, again, it's going to get cold and people are going to need to heat their homes. So we have that Russia and Ukraine conflict. We have just seen what happens with the Bank of England and what happens if they try to basically back off and go back into quantitative easing. So again, the United States and the Fed and Jerome Powell are kind of going to set the standard of what these larger players in the global macro economy need to be doing. In my opinion, Powell isn't necessarily going to be backing off at all. There's not really a reason to at this point. When you look at all of the data as a whole, specifically the inflation data, nothing has really gotten better. So guys, that is going to wrap up this video here. If you did enjoy the information and analysis that I provided for you guys in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So hope you guys are having a great evening. I'll see you guys in the next one. Peace.